Ladies and gentlemen, today I saw an article that's just published, and they state that DBS Research has come out with a very bullish and ambitious prediction and say a few things that I think are delusional. I don't even think in a, I don't even think it's possible. So now I would like to call out and let's take a look what I think are delusional and my reasons behind. So, in this release of a research discovery, DBS have actually published their 2040 prediction. And there were three major predictions that they do, which is number one, about GDP, number two, about the STI, and third is about the Sing dollar and the US exchange rate. And I want to say that at this juncture, I think it's delusional for quite a lot of them. But let's watch my explanation. So the bold headlines is this: DBS 2040 vision is that Singapore GDP will double to 1.2 to 1.4 trillion dollars. That's later I'll probably dig into the detail and see whether that's possible. And they actually think that the Sing dollar to the US dollar will have one-to-one parity. I'll also discuss and see whether this is possible. And for the STI from its current 4,000 points level to surge by almost 150% to hit 10,000 points in 2040. Let's examine and see whether that's possible. We use mathematics, economics, and logic to test whether this optimism can survive economic reality, shall we? So at a glance, for the GDP and the STI and all this, we have to see some of these numbers on paper. So the mathematics for GDP looks like this. Right now, our GDP is roughly about $550 billion for Singapore, which is actually quite a good number. And that's 2024. I'm sure this year will do much better. And the in order for it to hit $1 over trillion, first the real GDP, that means excluding inflationary impact, the real GDP has to grow by about 2.3%, which is what they roughly predict. So it will grow to about $787 billion in real term. And the nominal term, which means you add inflation impact, it needs to hit 1.2 trillion to 1.4 trillion as what they predict. And that basically says that you need to have a 5% nominal growth to a 6% nominal growth. 5 to 6% nominal growth a year in GDP. Now, you may not need to have so much if your Sing dollar appreciates strongly to, let's say, on parity. Let's say it did. Okay, it did. The Sing dollar really appreciate to almost a one-to-one with US, but that still require a 2.3% real GDP increase to a 2% inflation increase, and all sum up with the Sing dollar. In total, we are looking at about 4% GDP increase, excluding appreciation of the Sing dollar. 4% GDP increase. Wow, that's pretty strong GDP increase for a mature economy. So is 4% GDP nominal increase possible? Well, it is possible if you look historically, but our country is now maturing more and more. It needs to maintain 4 to 5% nominal GDP increase for 15 years and couple that with a strong Sing dollar increase. That I think it's stretching. It's not impossible. It's stretching, and it's stretching quite a lot. But I think the real delusional one is the STI 10,000. But let's look at the numbers. In order for STI to hit 10,000 for its current 4,000 plus a bit, it require a compound annual growth rate. That means every year it needs to grow by 6.3%, roughly speaking, over 15 years. A 6% is a lot. Okay. Now, just to give you a few, the STI gives about 3% dividend yield. So the total return needed for the STI is 9.3% a year. That is on par with the S&P 500 for a mature low volatility index dominated by banks, REITs, defensive stock. I think it's very unrealistic. Okay, very unrealistic. So I think 6% total return maybe is possible, but 6% nominal return a year, I think is very, very stretchy. So let's do a reality check, shall we? So if you take 1990 to 2005, the STI CAGR, that means the compound annual growth rate per year is about 2.4%. If you add in the 3% dividend rate, it give you 5%. So 2005 to 2002, 2005 to 2025, over the last 20 years, the STI was a miserable 1.8%. But if you factor in the 3% dividend rate is 4.8%. But for DBS to say that you'll grow to 10,000, it has to grow by 6 over percent on just the price itself. On top of that, there's a 3% dividend, total 9 over percent. I think this part is quite delusional. Okay. Yeah. So to hit 9%, you're almost S&P 500 and even the lower bound of NASDAQ already. And for that to be achieved, despite being a dividend market, I think over pushing. I don't know who come out with this. It is it is clear until cannot clear. This is delusional. So on GDP side, I think it's stretchy, but it's still within possible range. It's stretchy, yeah. And we all hope that they are right on the GDP can double in 15 years or so. It is very optimistic, but not insane. Two things need to happen. The real GDP need to grow very strongly in a normal inflationary setting, and the Sing dollar need to appreciate a lot. Okay, but on the STI, I think to assume that it will grow at near Nasdaq level or even at on par with S&P 500 level with a high dividends growth, I think this one clear until cannot clear that is delusional. Let's talk about currency parity. Is it possible? I think it's stretchy, not impossible. The Sing dollar is currently very strong, and for it to appreciate 1% a year for 15 years, I think MAS need to intervene quite a lot. And I don't think MAS wearing the economist hat want our Sing dollar to appreciate so much unless there's a very strong inflationary pressure, which I don't think will happen, okay, because in order for inflationary pressure to spike up, just like what we see the previous years, it needs to have massive printing of money or some supply shock. I'm not saying it's impossible, but I think it's stretchy to push that. So for DBS research analysts to make a claim that you'll be 1:1 require MAS to be delusional as well as the DBS economists. So I don't think MAS want to do that because that will cause our exports to be very, very expensive, and we do need some stability in that. So for it to appreciate 1% a year, I think is quite pushy. Don't forget, since 2012, 2011 until now, the Sing dollar has not returned back to the previous level. 2011, 2012, I was in US. The US dollar to the Sing dollar was $1.22 to 1. I was there. I spent wonderfully US dollar. It was very cheap. It has since then appreciated. Okay. Yes, it appreciated to a high of $1.40 or so, but now it's $1.30. It is still appreciated over the last 12 years, 13 years or so. For it to now reverse and depreciate rapidly, and is assuming MAS is not intervening it, I think a DBS research economists really need to go back to economic school and take a look. What is common sense? For also another things to take note is, I mean, Singapore has also risks involved. We are still a very open, small economy, and we could be hit by many of the uncertainties that are happening. So we do have an aging population. Our shrinking workforce is an issue. Trade barriers over the next 15 years, we don't know. AI's impact, we don't know. So DBS model assumes a smooth world, which rarely happen in practice. But at least this part I can give it to them in an optimistic world what it could be. I think taking DBS aside, for our economy to do really well, we must be able to survive all the economic shocks that will happen. It's not a matter of will or will. It's not will or will not. It's a matter of when. We do have some potential risks out there. We are a small economy. We are a price taker. We are a recipient of many global things that are happening to us. One thing I want to take note, which irritates a hell of people, is that we do have a political risk, and if our ruling party PAP do not receive the support that they need, foreign investors and all this could suddenly pull out and suddenly weaken the Sing dollar as well, and our GDP could be hit as well. I also want to caution that even if the GDP could be doubled in a very optimistic world that DBS research analysts are dreaming of, it usually doesn't transform into stock market boom. We have been doing well historically for last 10, 20 years in our GDP, but the STI only came back this year. Okay, so GDP growth and stock market boom doesn't go hand in hand. And we also need to take note that our STI is dominated by banks, Singtel, property, REITs, and limited upside potential. In terms of strong growth, there are no growth engine there. There are only stability, dividend issuing companies. So I would generally expect a 4 to 6% total return and not that 9% that the DBS research analysts are thinking. But that's purely my view. So don't bet on a, though I wouldn't bet on optimistic 9% growth that DBS is assuming. So don't you assume that whatever DBS said is going to come true and you bet your whole heirloom into the STI index. Is very dangerous. So this is what I think a more realistic scenario. Real GDP growth is about 2% versus what DBS optimistic view is. And the nominal growth will be hovering around 4 to 4.5%. I wouldn't think that the SGD and USD will flat to 1 to 1. I think it will be closer to 1.2 in a more realistic scenario. STI price growth a year, not some insane 6%. I would think is around half of that or so. Total return around 6% instead of 9%. This is what I think a more realistic scenario, and that will be a good planning assumption that you go in for your retirement funds. So in conclusion, my view is this. I think there is a optimistic macroeconomics planning scenario or forecast made by DBS research analysts. I think it's stretchy on the GDP side, not impossible, very stretchy. The STI 10,000 is smoking weed, in my view. Okay, maybe they are seeing something that I don't see. Okay, and I think that sensible investors like us, I think we want to be a bit more cautious in taking some of this view. I think DBS is a great bank, but I think a 2040 overly optimistic prediction is a fairy tale that we got to be careful. We want to take belief in it. Let's have a discussion, shall we? Okay, I could be wrong in this whole thing, but I'm happy to be challenged on these views. Let me know what's your view of my talk today, and happy to have a discussion with you in the live stream tonight. Okay, see you and goodbye.